If you've been in an accident, you might expect your insurer to fix your car and hand it back. Instead, you sometimes get a different answer. The car is a total loss. And here's what surprises a lot of people. The car can still be drivable. It can have a crumpled fender, a deployed airbag, or frame damage that's fully repairable. None of that automatically means it's beyond saving. So why does the insurance company call it totaled anyway? The short version is that total loss is not really about whether a car can be fixed. It's about money. Insurers compare the cost to repair the car against what the car is worth, and when those two numbers get close enough, fixing it stops making financial sense to them. In this video, we'll walk through the actual math behind that decision, how repair estimates work, what actual cash value really means, the role of salvage value, and the state thresholds that can tip a borderline car over the edge. Rules and numbers vary by state, by insurer, and by your specific car, so treat this as general background, not advice for your exact claim. Let's clear up the biggest misconception first. A total loss doesn't mean your car is physically destroyed. A car can be totaled and still start, steer, and drive down the road. The term is an accounting decision, not a mechanical one. From the insurer's point of view, your car has a value, and repairing it has a cost. When the cost of repairs climbs high enough relative to that value, the company decides it makes more sense to pay you for the car than to fix it. At that point, they declare it a total loss, take ownership of the damaged vehicle, and write you a check based on what the car was worth before the crash. Think of it like a phone with a cracked screen. If the repair costs almost as much as buying a comparable used phone, you'd probably replace it instead. Insurers run the same logic, just with a formula and a dollar threshold behind it. So the real question isn't, can it be fixed? The question is, does fixing it cost too much compared to what the car is worth? That second question is where the formula comes in. Here's the basic comparison nearly every insurer makes. On one side, you have the estimated cost of repairs. On the other, you have the car's actual cash value, often shortened to ACV, which is roughly what your car was worth right before the accident. Insurers weigh repair cost against that value. There are two common ways they frame it. The first is a straightforward comparison. If repairs cost more than the car is worth, it's almost always a total loss, because nobody pays $12,000 to fix a car worth $10,000. The second, and more common in practice, involves salvage value. Even a wrecked car has some worth as parts or scrap, and that's the salvage value. So a more complete way insurers think about it is, does the cost of repairs, plus what they'd get back by selling the wreck for salvage, exceed the car's pre-accident value? When repairs plus the lost salvage opportunity push past what the car was worth, totaling it is the cheaper path for the insurer. This is why a car with $8,000 in damage and an actual cash value of $9,000 can still be totaled. The repair number alone didn't beat the value, but once salvage is factored in, the economics tip over. Beyond an insurer's own math, many states set a legal trigger called a total loss threshold, sometimes written as TLT. This is a percentage. When the cost of repairs reaches that percentage of the car's actual cash value, the car must be declared a total loss, regardless of whether the insurer would have chosen to fix it. In threshold states, the percentage is commonly somewhere in the range of 70 to 75%, though the exact figure differs from state to state and can change over time. So in a state with a 75% threshold, a car worth $10,000 would generally be totaled once repair estimates hit $7,500. Other states don't use a fixed percentage at all. Instead, they use what's called a total loss formula, where the car is totaled if repair cost plus salvage value exceeds its actual cash value. Because these rules are set at the state level, the same damage to the same car could be handled differently depending on where it's registered or where the accident happened. This is one of the biggest reasons we keep saying outcomes vary by state. To know what applies to you, check your state's insurance department or ask a licensed agent. Since actual cash value sits at the center of this whole decision, it's worth understanding what it actually is, because it directly shapes your payout. Actual cash value is generally what your specific car was worth in the moments before the accident. That's not what you originally paid for it, and it's usually not what it would cost to buy a brand new replacement. It reflects depreciation, the gradual loss of value as a car ages and racks up miles. To estimate ACV, insurers typically look at what comparable vehicles, the same year, make, model, trim, mileage, and condition, are selling for in your local market. They may also use valuation tools and databases. Features, recent maintenance, and overall condition can nudge the number up or down. Here's the practical takeaway. When a car is totaled, your payout is based on this pre-accident value, not on the loan you still owe or the price of a shiny new model on the lot. That gap surprises people, especially on newer cars or financed vehicles, which is exactly why optional coverages like gap insurance exist. If you disagree with the valuation, you can usually ask the insurer how they reached it and provide your own comparable listings or documentation. Now we can answer the question that brings most people here. Why would an insurer total a car that a shop could clearly repair? The answer almost always comes down to the numbers we've covered, not the mechanical possibility. A few things commonly push a repairable car over the line. First, hidden damage. The visible dents are only part of the story. Once a shop disassembles the car, they often find bent structural components, damaged sensors, or electrical issues that balloon the estimate. Second, the cost of modern parts and safety systems. Today's cars are packed with cameras, radar, and airbags, and replacing and recalibrating those is expensive, so estimates climb faster than they did on older vehicles. Third, the car's value. An older, high-mileage car has a low actual cash value, so even moderate damage can exceed the threshold quickly. Put simply, a low-value car needs surprisingly little damage to be totaled, while a high-value car can absorb a lot. None of this means the car couldn't be driven again. It means that, by the formula and the state rules, paying you out costs the insurer less than repairing it. Whether that result feels fair is a separate question from how it's calculated. If your car is declared a total loss, a few things typically follow, and knowing them helps you avoid surprises. The insurer pays you the actual cash value, generally minus your deductible, and in exchange takes ownership of the vehicle to sell for salvage. If you owe money on the car, the payout first goes toward the loan, and if the payout is less than the balance, you can be left owing the difference unless you carry gap coverage. The title on a totaled car usually changes to a salvage or similar branded title, which affects whether and how it can be sold or driven later. In some states, you may have the option to keep the wrecked vehicle, in which case the insurer subtracts the salvage value from your check. You usually have the right to question the valuation and to negotiate if you have solid evidence of higher comparable values. And remember, every step here, deductibles, title rules, owner retention options, and how disputes are handled varies by state, by insurer, and by your policy. Read your policy and lean on official sources or a licensed agent for the specifics. So here's the bottom line on how insurers decide a car is a total loss. It isn't really about whether the car can be repaired. It's about whether repairing it makes financial sense compared to the car's value. Insurers weigh the repair estimate against your car's actual cash value, often factoring in salvage value, and many states add a total loss threshold or formula that can force the call once repairs reach a certain share of that value. That's why a perfectly fixable car, especially an older or lower value one, can still be declared totaled, and why your payout is tied to the car's pre-accident worth rather than your loan balance or a new car's price. Understanding these moving parts, repair cost, actual cash value, salvage, and state rules, won't change the math, but it can help you read your own situation more clearly, ask better questions, and recognize when it's worth providing your own comparable values. Because thresholds, valuations, and procedures differ by state, insurer, and vehicle, treat this as general education, not a prediction for your claim, and consult a licensed agent or your state insurance department for guidance on your specific situation.